Yen's respite proves short-lived with Fed in focus. December 12, 2013. The yen retreated toward recent lows against the dollar and the euro in Asia on Thursday, failing to capitalize on the small bounce as markets positioned for a possible scaling back of the Federal Reserve's stimulus as early as next week. News that Congress has reached a bipartisan budget deal that would end 3 years of impasse and fiscal instability was seen clearing a potential hurdle for the Fed to tamper its massive bond buying program. Investors' appetite for risk waned on the growing possibility of an earlier-than-expected stimulus reduction by the Fed at its final policy meeting for 2013 next Tuesday and Wednesday. MSCI's broadest index of Asia-Pacific shares outside Japan fell 1%, its sharpest one-day fall in 3 weeks. The sell-off in risk assets initially prompted a squeeze on short yen positions, which saw the euro slip as low as 141.20 yen, pulling away from a 5-year peak of 142.19 set on Tuesday. That move proved short-lived as the euro bounced back to 141.42 yen, up 0.2% on the day. The cross-yen rates continue to march on higher, said Bart Wakabayashi, head of Forex at State Street Global Markets in Tokyo, who said the impact on currencies of the U.S. budget impasse resolution was muted. The dollar fetched 102.58 yen, still below a 7-month high of 103.40 yen touched on Tuesday, but up to about 0.2% on the day and off a session low of 102.39 yen. The dollar's next test is seen at 103.50 yen, with talk of an options-related barrier there. That was a pretty healthy move down, but we're back where we are, so that level will be challenged again, Wakabayashi said. The Australian dollar, often sold in times of heightened risk aversion, fell about 0.2% against the greenback. It last stood at $0.9023, despite data showing Australian employment increased by 21,000 in November to handily beat expectations as more full and part-time positions were created. In contrast, the Reserve Bank of New Zealand maintained its hawkish stance on Thursday, signaling that interest rates could start rising in the first half of next year. That helped push the Kiwi to 0.8275, up about 0.2% and well off its overnight low of 0.8201. The dollar was steady at 79.883, but struggled to go higher as the euro edged up against the U.S. unit. The common currency has climbed nearly 4% since November 11 and was up about 0.1% at $1.3793, within easy reach of its 2013 peak of $1.3833 set back in October. The latest run higher was fueled by growing expectations the European Central Bank will not be providing fresh stimulus anytime soon, although some analysts are starting to see little value in the euro at current levels. We entered a short European euro versus United States dollar recommendation Wednesday, targeting a move down to 1.32 with our stop set at 1.3975, analysts at BNP Paribas wrote in a note to clients. We think rate differentials are likely to move against the euro once again in near term, they said, adding the euro/dollar was trading rich according to their analysts. There was little reaction to media reports that Stanley Fischer, who led the Bank of Israel for 8 years until he stepped down in June, could become the Fed's next vice chair. Sebastian Galli, strategist at Societe Generale, said Fischer was a mentor of the current Fed chairman, Ben Bernanke, and is very rationally a dove when needed. Such a view, if it becomes widespread, could potentially weigh on the greenback.